Hatem Dhiab's with us, managing partner, Gerber, Kawasaki, Wealth and Investment Management, and Sandra Cho, founder and president, Point Wealth Capital Management. Hatem, I'll start with you. Were you surprised to see the subscribers loss that we saw for Disney Plus?
Hey, Nicole, good to see you. Yeah, not a very magical quarter because of the subs being lost, especially in India. I think Hotstar hasn't done that well for them, but also the losses in streaming, which were expected to, also did not help the stock. So I think everyone is really disappointed at this point.
Yeah, I mean, as we saw these subs here coming in, and then also, they have the parks, they have movies. What did you think, Sandra? What was your takeaway?
Well, I thought on a bright spot, the parks, experiences, and products were up 17% for the quarter. So that boded well. There were losses in streaming, but the losses were actually $200 million below what expectation was going to be.
So losses were less bad than expected.
Yeah.
What do you think, Sandra? If I could say it like that, what do you think Bob Iger's path is here, and what is he doing right, Sandra?
Well, I think the deep reorganization that he announced and a focus on profitability is really just the main thing. I think also it's interesting what's going on right now with DeSantis and Disney. I think we're all kind of watching. But he's focusing right now on, obviously the lawsuit, but also the fact that there is an immense investment that Disney makes in the state of Florida. So I think that he is, focused on these couple things and just spinning a positive image for Disney and just moving forward.
Yeah, and I think, as we talk about the image, I mean, our last guest, Todd Sohn, said they are huge Disney fans in their house. They just went to Disney. The ticket prices had gone up. It's super expensive, but just won't give it up. I mean, when I look at the parks revenue, it's $6.76 billion, and the parks operating income, $1.68 billion. I mean, it looks pretty great here, Hatem. What do you think Bob Iger wants to focus on now?
Yeah, I think that's absolutely right. Like the parks and also anything that relates to merchandising, right? So there was more money spent per visitor at the parks. There was more visitors in the parks. If you look at China, for example, China just reopening after being closed for many, many years. So I think the growth there is tremendous, and at 17 or 20% growth, I mean, that's a great thing. But also more importantly, I think the refocus on the direct-to-consumer streaming by combining the Super app with Hulu tells you that Disney is going to double down on streaming. They're going to try to go after both family entertainment and general entertainment, and Iger is really trying to kind of ride up the ship and put them in the next phase of growth.
Yeah, Sandra, your thoughts there on the Hulu idea?
Well, I definitely agree that Disney is betting on streaming. Their free cash flow has fallen 96%, mostly because they're investing heavily into streaming, and I do think that is going to pay off. I love what they've done with Hulu and their direct-to-consumer products.
As I think about the competitive landscape, Hatem, when we look at what happened with Paramount, for example, Apple TV doesn't have, people come and go, they watch a show and then they quit subscribing. Linear TV, the way we knew it, is, once a month you paid the cable guy and you got all the channels. There's so much volatility and switching around, and, can you really, is there enough space for this? Can you quantify how this is actually going to work when the ad dollars are stretched so thin? Now we have writers' strike to contend with too, Hatem.
Yeah, so there is a few things there. First of all, I think advertising revenues in the face of economic slowdowns are going to go down drastically, and you've seen that in free fall. You've seen it at Disney, you've seen it at Paramount, as you mentioned. So that's a big problem. However, Disney is also trying to send some subs or really drive subs to their ad tier because the ad tier is actually more profitable than subscriber tier. And what that means is actually Disney thinks that they can actually drive more advertising revenue towards their direct-to-consumer business, and they think that's actually a profitable move. And I think Netflix is going to do that, or started to do that, and other apps will do it. So in the competitive landscape, there is going to be a room for ads. It's just going to be a different way of serving up those ads.
Yeah, you mentioned cruises in China too, Hatem, in your notes. Tell me about that quickly. Those are bullish spots, right?
Super bullish. I mean, I think Disney had a new ship that's done really, really well. So people like cruises. It's not for me, but people love to take their kids on cruises. China is really the brightest spot, I think. You know, it's a big country. People have been basically locked down for years, and they like to do fun things.
Let me ask you this. So do you think the stock goes higher? It's at $92. Hatem, I know you won't give me an exact number, but is this fairly priced, or you see an upside?
Listen, it's not a cheap stock at these valuations. As Sandra mentioned, the free cash flow is down tremendously. It's been a rough ride for 9 years, you know, frankly, with COVID and so forth. But, you know, if you believe in this transition, if you believe in what Iger is doing and this pivot towards streaming, I think the stock could go much higher.
Okay, Sandra, quickly.
Yeah, I totally agree with that. I think, you know, the diversification that Disney has, Iger is back, and, you know, I'm betting on the mouse.
Oh, that's great. Great to see you both. Sandra and Hatem Dhiab of Gerber, Kawasaki Wealth and Investment Management, and Sandra Cho, Point Wealth Capital Management. Thank you very much breaking down Disney there.